Hello everyone. Given the demographics, given the formalization of your economy, given the regulatory changes that have happened, given the supply chain rejig that is happening globally, there are several opportunities which are high growth opportunities which are getting created in the Indian economy. And to capture those opportunities, Canara Robeco has decided to launch Canara Robeco Mid Cap Fund. This is a new fund offer. It will be between date of 11th of November to 25th of November. Let us go through the details of the NFO. Within the product, we will discuss three parts. First, the core portfolio philosophy. The second, portfolio construct. And the last will be the exclusions, what will not come in the portfolio. Let us start with the first part. The first part is basically what is the core philosophy or what is the core thought process that we are planning to run in this portfolio. The core thought process is very simple. It has to be a quality growth. Okay, and to get the quality growth, you need to get intersection of the industry growth, the company growth, and you also need to get the promoter quality in place, which is what ensures that the quality of growth is superior. So when we will kind of construct the product, the core thought process will remain that effectively the industry growth has to be superior to the other industries. Within that industry, you have to own leaders or domestic beneficiaries who will have superior growth within that industry, which means higher than the industry growth. And these two factors will have to come along with the promoter quality or the business quality, whereby your capital efficiency or capital allocation is not challenged. An intersection of these three things will be the core part of this portfolio, what we will call as basically the high growth companies. Let us go into the second part, which is the portfolio construct part of it. Portfolio will actually stand on three pillars. First would be the high growth companies, second would be the compounding companies, and the last would be the turnaround sectors or cyclical sectors. Now let me explain one by one. The first is high growth companies. Clearly that's the core part of the portfolio. Among these three, that will be the predominant part of the portfolio. And these high growth companies are beneficiaries of broader themes such as formalization of economy, change in per capita income, change in the consumption patterns, as well as change in the supply chain, global supply chain rejig that is happening. Now, how is it reflecting in the actual parameters? So how do you basically arrive at buckets which define high growth companies? So when you look at the buckets, typically these are the companies where either the company is gaining market share within the sector, one, or the sector is growing itself at a faster pace because it's an emerging theme. Third, because the industry is getting formalized, which means the industry is getting organized, which is happening across the industries in India with per capita income. Fourth, because there are regulatory changes or formalization of economy is happening because of that regulatory changes. For example, with GST, with the Jan Dhan, with the lower taxes in the economy, and several changes thereof which have happened in the economy, which is leading to a lot of again sectors getting more formalized and thus high growth industry showing up. So this is the basket where you are looking for high growth companies. These are not exhaustive characteristics, but these are some of the characteristics which you are looking at, which will, or catalysts which you are looking at, which will translate into high growth companies. Clearly these high growth companies display growth leadership qualities. They are typically beneficiaries of the domestic formalization of economy. This will be the first part of the portfolio, and this will be predominant part of the portfolio, as I said. Second part would be the compounding part of the portfolio. Clearly, while high growth companies will give me higher earnings, superior earnings growth and superior alpha thereof on a risk-adjusted basis through cycles, the second part, compounding, will give a lot of resilience to portfolio. Compounding businesses are the businesses which are proven businesses. They might not be the highest growth companies, but they are steady growth companies with high capital efficiency, proven business models, some form of competitive edge. So they witness a lot of resilience. They give a lot of resilience to portfolio through cycles. So that's the second part. Coming to the third part is basically the turnaround beneficiaries or cyclical industry. These are businesses where the earnings and the re-rating, both of these factors are happening as an outcome of several possible catalysts. And again, these catalysts are not exhaustive, but the catalysts like capital allocation in a particular sector or company is changing. The competitive intensity in a sector is changing. So the earnings are showing tailwinds. Third, for example, in banks, the credit cost cycle is coming to an end, so you're getting earnings tailwind. It could be sheer operating leverage or financial leverage which is playing out. So there can be a number of reasons for which the earnings for a cyclical period likely to show, and when I'm saying cyclical, for 1 or 2 years or 3 years, are likely to show a significant turnaround in the growth rates. And when that happens, you also get re-rating. So that will be the third part, where you will capture this re-rating in the earnings and thus the re-rating in the underlying stocks or businesses. So that will be the three-pronged strategy. So you have the largest part, to summarize it, you have the largest part, which is the leaders, domestic beneficiaries, which are high growth companies. That's the first and largest pillar of the portfolio, which is largely, to summarize it, is a function of basically the formalization of economy, the emerging consumer trends because of the per capita, as well as the emerging changes that are happening in terms of the supply chain rejig that is happening globally. That's the first. Second is, as I said, compounding, which is very easy to understand, and the third is the cyclical turnaround. So that's the three-part portfolio construct that we intend to have in Canara Robeco mid-cap scheme. Lastly, the portfolio has exclusions to manage the risk, as we believe that managing risk is as important as creating alpha. And these exclusions would be, one, if there is anything on integrity related as far as promoters are concerned or capital allocation related, that's one. Second, if the businesses have not created free cash flows through cycle. Third, if the company has very high working capital cycle. Fourth, if the company has very high growth and high leverage. And fifth would be companies which through cycle have low ROE and ROCs. So those would be the exclusions that this portfolio would have on general basis. That's what from our side. Thank you. Happy investing.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.